Today, we have a very important update that could have major implications not only for the broader financial markets, but also for the future of cryptocurrency, especially XRP. There are several developments unfolding right now that many investors appear to be overlooking, and in my opinion, some of these developments could end up becoming extremely significant over the coming months and years. We're going to discuss the latest comments from Federal Reserve Chairman Kevin Warsh, why the market may be reacting incorrectly to what was said, how future interest rate policy could evolve, a surprising development involving Ripple and a well-known public figure, the growing utility narrative surrounding XRP, and finally a concern that continues to develop around MicroStrategy that many investors are not paying enough attention to. Hey guys, welcome back to Whiteboard Crypto Update. In today's video, we will talk about XRP. So be sure to stay focused, as you surely don't want to miss out on this. If you're new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads. This video is for educational purposes only. It is not financial advice. Always do your own research before making any investment decisions. Let's start with the Federal Reserve meeting. This was one of the first major meetings under Kevin Warsh's leadership, and many people were expecting dramatic changes immediately. However, the meeting largely unfolded as expected. Interest rates remained unchanged, and there was no sudden announcement that would immediately satisfy those hoping for aggressive monetary easing. Personally, I never expected major rate cuts to happen right away. When a new Federal Reserve chair steps into the role, immediately implementing a political agenda could create significant criticism and raise concerns about the independence of the central bank. Because of that, it makes sense that the first meetings would be relatively cautious. However, buried within the comments made by Kevin Warsh was something that I believe could be far more important than the headlines that dominated financial news coverage. One of the key points he mentioned was the possibility of reevaluating how inflation is measured. At first glance, this may sound like a technical issue that only economists care about, but in reality, it could have massive implications for future monetary policy. Think about it this way. Inflation can be measured in many different ways. Certain goods become cheaper over time due to improvements in manufacturing, technology, and efficiency. Electronics, televisions, computers, and many consumer products often decrease in price as production methods improve. At the same time, other sectors such as housing, healthcare, and services may experience persistent inflation and rising costs. Because inflation is not a single number that exists naturally, governments and central banks must decide which components deserve more weight and which components deserve less. Different methodologies can produce different outcomes. That is why I believe this discussion is so important. In my view, when a Federal Reserve chairman begins talking about changing inflation metrics, it is not simply an academic exercise. Instead, it suggests that policymakers may be searching for a framework that better supports the type of policy direction they want to pursue. And what policy direction has many people associated with Kevin Warsh and the current administration? Lower interest rates. If inflation appears lower under a revised measurement system, it becomes easier to justify future rate cuts. That possibility is what I believe the market may be underestimating right now. Many traders focused on what Warsh did not say. They wanted an immediate promise of aggressive rate reductions. Since they did not receive that promise, markets reacted negatively. But in my opinion, the more important signal was hidden beneath the surface. Historically, monetary policy moves in cycles. We have seen periods of low rates followed by periods of high rates, and then eventually a return to lower rates again. After experiencing one of the most aggressive tightening cycles in recent history, it would not be surprising to eventually see rates move significantly lower over the remainder of the current administration. Even several Federal Reserve officials have suggested that lower rates may be appropriate in the future under the right economic conditions. That is why I view these comments about inflation measurements as potentially very bullish for risk assets, including cryptocurrencies. Now let's shift our attention to Ripple, because something very interesting appears to be happening. Reports indicate that Matt Damon, who is associated with Water.org and has connections to organizations utilizing Ripple payments technology, may be attending Ripple Swell. For longtime XRP supporters, this development is particularly interesting because it reminds many people of an earlier era. Years ago, Ripple had significant visibility among celebrities and mainstream media personalities. XRP was receiving attention from major public figures and appearing in mainstream discussions. Then suddenly, much of that visibility disappeared. Many observers believe the regulatory uncertainty surrounding the SEC lawsuit played a major role in that shift. Companies and public figures often become more cautious when legal questions remain unresolved. But now, as regulatory clarity continues improving, we may be witnessing the beginning of a return to mainstream visibility for Ripple. Now, I want to be clear about something. Celebrity involvement alone does not create value. A famous person appearing at an event does not automatically make an investment successful. However, awareness matters. The reality is that many of the world's most successful investments also happen to be among the most recognizable names on the planet. Companies like Apple, Nvidia, and Tesla benefit not only from strong businesses, but also from enormous public awareness. The more people know about an asset, the more likely they are to research it, discuss it, and potentially invest in it. That is why increased public visibility can be beneficial when it is combined with strong fundamentals. And speaking of fundamentals, one of the most exciting narratives surrounding XRP continues to gain traction. A concept that has recently been discussed more frequently is the idea of XRP acting as a universal liquidity bridge. Some analysts have even started referring to XRP as a type of liquidity intermediary, capable of connecting different financial assets instantly and efficiently. Imagine tokenized treasury bills, stablecoins denominated in different currencies, tokenized real-world assets, and traditional financial instruments all existing on separate networks. Without a neutral bridge asset, every system would require numerous direct trading pairs and liquidity pools. The result would be fragmented liquidity and reduced efficiency. XRP offers an alternative vision. Instead of requiring countless individual liquidity pairs, XRP can potentially function as the intermediary layer connecting everything together. For example, a euro-denominated stablecoin could be converted into XRP and then instantly converted into a US dollar stablecoin. A tokenized treasury bill could be exchanged through XRP into another tokenized asset without requiring separate liquidity infrastructure for every possible combination. This creates a model where liquidity becomes concentrated rather than fragmented. And that is what makes this narrative so powerful. Unlike many blockchain projects whose tokens have questionable utility, XRP's value proposition is directly connected to the role of the asset itself. There are countless crypto projects whose teams barely discuss the importance of their native token. Some projects focus entirely on fundraising, governance, or speculative activity. But XRP's core narrative revolves around facilitating value transfer between assets, institutions, and markets. That utility is tangible. That utility is understandable. And perhaps most importantly, that utility scales as adoption grows. When you compare the complexity of today's financial system with the streamlined vision proposed by the XRP ledger, the potential advantages become easier to appreciate. Instead of maintaining countless liquidity corridors, institutions could potentially access a single pool of liquidity that connects everything. That is a compelling long-term thesis. And that is why I believe increased public awareness, whether through events like Ripple Swell or participation from high-profile individuals, could ultimately benefit XRP as long as the underlying fundamentals remain strong. Now, before we finish, I want to touch on something that continues to concern me in the broader cryptocurrency market. That issue is MicroStrategy. For quite some time, I have expressed concerns about certain aspects of the company's financial structure. Recently, attention has focused on one of the company's preferred share products known as STRC. This product offers investors an attractive dividend yield, but there is an important issue that investors should monitor carefully. The market value of these preferred shares has been declining rapidly. If the underlying principal value is eroding faster than the dividends can compensate for, investors may begin questioning the long-term attractiveness of the product. This becomes especially important because these financial instruments play a role in the broader strategy the company is using to continue accumulating Bitcoin and financing operations. There have been numerous theories suggesting that MicroStrategy could eventually become deeply integrated into national financial infrastructure or even serve as some form of strategic Bitcoin reserve vehicle. Whether those theories are realistic remains open for debate. But when I examine the current situation, I see risks that many market participants may not fully appreciate. Interestingly, some of the most experienced individuals in finance and cryptocurrency who closely follow these developments have also expressed concerns. This does not mean disaster is guaranteed. It does not mean a collapse is imminent. However, it does suggest that investors should remain cautious and pay attention to what is happening behind the scenes. If there is one area of the crypto market that currently makes me uneasy, this is probably near the top of the list. Could it affect XRP directly? In my opinion, probably not. But if significant stress emerges within the broader crypto ecosystem, it could temporarily impact overall market sentiment, liquidity, and investor confidence. That is something worth monitoring. As always, the most important thing is to focus on long-term fundamentals rather than short-term noise. Right now, we are seeing potential signs of future monetary easing, growing institutional interest in blockchain technology, increasing visibility for Ripple, stronger recognition of XRP's liquidity utility, and continued evolution within the digital asset industry. The road ahead will likely remain volatile, but these are exactly the kinds of developments that long-term investors should be paying attention to. Well, guys, that's all we have for you today. What are your thoughts on XRP? Get involved and let us know in the comments down below. Thank you for watching.